All right, welcome to The Explainer. Today we're going to talk about something that is, it's the absolute bedrock of trust in fintech. We're talking about how your money, your stocks, all your assets are kept safe from the very companies that are supposed to be holding them. So let's just get right to it with the big one. What really happens to your stocks if the firm holding them goes bankrupt? This is a pretty high-stakes question, right? And the answer, you might be surprised to hear, it's not some dusty legal footnote. Nope. It's actually a core principle that's hardwired right into the software that powers all of modern finance. And how does that protection work? Well, the whole system really hinges on this one core legal and ethical obligation. This isn't just an optional feature or a nice to have. We're talking about a fiduciary duty. It's a non-negotiable promise that every single financial custodian has to make. And that duty? It has a name. It's called asset segregation. It's a really simple but super powerful rule. Basically, a bank cannot, under any circumstances, mix its own money, its own operational funds, with client funds. Your assets have to be completely walled off, protected, and accounted for totally separately. Okay, so this is where it gets really interesting for all the developers out there. Think of it like a digital firewall, just like you see here. Asset segregation isn't just some abstract idea for lawyers to argue about in a courtroom. No way. It is a direct mandate for how we build systems. We are literally the ones translating this legal promise into the actual technical architecture. And that's so critical for IT because, look, this legal principle, it directly shapes your day-to-day work. It's going to dictate the entire architecture of your asset ledger. It forces you to have a database schema that can identify the true owner of every single security. And, of course, it drives all of your core accounting logic. At the end of the day, your code becomes the final line of defense. So the big question is, how do we actually do this? How is this separation achieved in the real world? Well, it pretty much boils down to two primary methods. And you can think of them as two fundamentally different philosophies when it comes to structuring and protecting client assets. So on one hand, you've got what are called omnibus accounts. The best analogy is a shared locker room, right? All the assets from multiple clients are just pulled together in one giant account. And on the other hand, you have nominee accounts. This is the complete opposite. Think of it like a private vault, where each client's assets are held in their own separate, designated account. Okay, so we have the shared locker room versus the private vault. Now, this difference becomes absolutely critical when we start looking at it from an external point of view, specifically from the perspective of how the overall system actually sees your assets. So how does the Central Securities Depository, or CSD, see these accounts? The CSD is the ultimate record keeper. It's the source of truth for who owns what. And the key distinction, the whole game between these two methods, is all about what the CSD can see versus what the bank's internal IT systems are responsible for tracking. Let's look at the omnibus view first. Externally, from the CSD's perspective, it just sees one single massive account that belongs to the custodian. That's it. It has absolutely no idea who the hundreds of individual clients are. So internally, all the heavy lifting of tracking who owns what slice of that pie, that all happens inside the bank's own IT ledger. And the IT implication there is huge. For you, the developer, this means your code, your subledger processing and reconciliation logic has to be incredibly robust. It becomes the single source of truth. It has to be perfect because it's the only thing responsible for correctly slicing up that giant pie and allocating everything from dividends to ownership. Now let's flip it and look at the nominee view. It's a totally different story. Externally, the CSD sees everything. It sees hundreds of separate accounts, one for each individual client. So the bank's internal IT ledger, its job is way simpler. It just maintains a direct one-to-one link to each of those external accounts. So what's the IT implication here? Well, it's a classic trade-off. The reconciliation logic is way simpler, right? You're just matching one thing to one thing. But, and this is a big but, the administrative overhead is much, much higher. Think about the operational work involved in managing hundreds or even thousands of separate accounts. Okay, so we've got our two models, the efficient pooled omnibus model and the super secure individual nominee model. Let's really put them through a systems stress test. Let's see how they actually perform under pressure. And this table really breaks it all down. Let's take something like corporate actions, dividend payments. With Omnibus, it's complex. One big payment comes in and your system has to figure out how to allocate it to all the different clients. With Nominee, it's way simpler, separate payments for each client. But now look at the big one, insolvency risk. With Omnibus, because everything is commingled, there's a moderate risk of delays in a crisis. With Nominee, the risk is minimal. Your assets are clearly ring-fenced at every single level.
So let's bring this all together. This is what I'm calling the developer's mandate, where code meets custody. If you're a developer, an architect, a product manager in fintech, this is not just some abstract theory. This is your job. The design decisions you make have direct, real-world consequences for protecting people's money.
And let's be super clear about this. Your database design, it becomes the ultimate safeguard for client assets. The system you're building isn't just a fancy transaction processor. Its structure, the very way you model your data, is the digital enforcement of that fiduciary duty we started with. So what does that actually look like in terms of key architectural requirements? Well, you absolutely need an account hierarchy in your data model to support those master and sub-accounts for Omnibus. You need what I call a segregation flag, a critical data point on every single asset record. Your reconciliation logic has to be smart enough to validate totals for Omnibus or do a one-to-one check for Nominee. And finally, your settlement instructions need the logic to correctly reference either that single Omnibus ID or a very specific Nominee ID. It really comes down to this quote. It's the eternal tug-of-war in fintech. Operational efficiency versus ultimate client protection. And that perfectly captures the core tension here. The choice between Omnibus and Nominee isn't just a technical one. It's a huge strategic decision. Are you going to prioritize the speed and lower cost of the pooled model, or the ironclad ultimate security of the individual model? And that really leaves us with a final massive question for the future, doesn't it? Efficiency or ultimate security? Which one will future financial systems prioritize? As tech makes everything faster and cheaper, is the industry just going to default to the most efficient path? Or will regulators, and maybe more importantly, clients, start demanding the ultimate security that you only get from true individual segregation? Honestly, the systems that we're all building today, they're going to be the answer to that question.